Episode 2, let's run the math through. What can you afford? Byron Watson, Darren Shepherd.
Hi, my name is Darren Shepherd. This is Byron Watson. We're here for episode number 2. Last week we spoke about are you ready to purchase a home? Or do you just want to purchase a home because of the societal pressures that we have placed upon us that says you should purchase a home even though you might not be ready? And so today we're going to take another step in that scenario, and I'm actually going to play the buyer, and Byron's going to be the mortgage advisor, and we're going to walk through different scenarios that you can see live on what we do to help people break down their financial picture and break down monthly payments so they can see if they're ready or not and if it fits their budget. Byron, did I cover everything on that?
Yeah, I think you did. This is going to be really exciting. So I think what we're going to do is you're going to kind of give me your scenario, just like you would if you were a buyer working with me, and then I'm going to go ahead and walk you through how much home that will allow you to afford. And we're going to look at this based on how an underwriter would look at this, and we could potentially talk about like what you can do versus what you should do as well. So why don't you go ahead and get started and tell me a little bit about your hypothetical buyer situation?
Okay, awesome. This is great. So let's start with a married couple. Let's start that direction. So
Okay.
I am a firefighter. I make $120,000 a year in overtime. My wife is a teacher, and she makes $75,000 a year being a teacher. We have about $10,000 in student loan debt. I have a truck, and I have about $12,000 in car loans. And, that's about it. We rent, we have no kids. We want to purchase a single family home, really don't want a townhome and or a condo. And we live in the Orange County area. We're open to other areas like Riverside County, Chino Hills or Chino or Corona. And so, but we know there's maybe tax differences, but not sure. But that's our scenario. And we would love to purchase a home.
Okay. Perfect. Do you know roughly how much you guys have saved for a down payment, or like what do you have in savings, brokerage, retirement accounts?
Yeah, so we have about $40,000 in savings, and we have about $100,000 between us in retirement accounts.
Got it. Okay, perfect. The student loan debt, do you know if that's is the payment in deferment, or is that something that's currently being paid?
No, we currently pay it.
What's the payment on that?
It's about $300 a month.
Got it. And how about for that $12,000 truck loan? How much is that per month?
That's about $500 a month.
Got it. Okay, so let's break this down. Oh, actually, one last question, which is FICO scores. Do you know roughly what your FICO scores are?
Yeah, we're about average, about 680 to 700.
Got it. Okay, perfect. All right. Do you know, with a FICO score, typically, for a conventional conforming loan, sometimes we want to see a FICO score that's higher than that so we can get the best interest rate possible. Do you know what's bringing the FICO score down? Is it just high utilization of credit cards, or is it late payments?
I don't know. Maybe you can tell me what you guys can do to help with that situation if needed, but I'm not sure.
Got it. So yeah, that is something that I do as a mortgage advisor. Is definitely look at what is bringing that credit score down. So I can do that through some credit tools that we have that allows me to, well, first of all, tell me what is bringing the score down. It will also give me some advice on what we can do immediately to bring the score up. Right. So if we were to run your hypothetical credit report, I could have that report for you and see what we can improve it to.
Okay, cool.
But today, really, we're focused on what you can do, right? Like how much home can you afford? So what we look at, let's just assume we're working with like a conventional conforming loan.
Mm-hmm.
Is the easiest loan type to try to qualify for, and essentially we can qualify you with a debt to income ratio as high as 50%, right?
Okay.
So that means you can spend 50% of your gross income on all of your combined debt.
Wow.
Now,
Okay.
I asked you about some very specific debt situations like your car loans, your student loans, your credit cards, and you really didn't have much, right? It was just a $12,000 car loan, and there was a small student loan. And notice that I didn't ask about, you said you have no kids, but even with families that do have kids, we don't ask about how much do you spend in childcare.
Yep.
We don't ask about the electricity bill or your cell phone bill or your insurance payments. Like we don't cover any of that.
Yep.
So keep in mind that when a lender is really looking at your debt to income ratio, they're being selective about what they're counting as part of your monthly payments.
Got
okay?
it. That's a really good point. Really good.
Yeah.
Point.
So strictly speaking, as a loan officer, if we look at this current situation, let's calculate the income first, right? So we're looking at looks like $195,000 of income, which means on a monthly basis, this person's earning about 16,200. I'm sorry, $16,250 per month. And remember, I said you can spend half of that, half of your gross income, on all of your debt, right? So that means you can spend every month $8,125 per month on all of your combined debt.
Wow. Yeah. So
And
we
so if we
definitely don't
look
want to
at
do that.
no, definitely don't want to do that, but let's look at what that encompasses, right? So right now we have to subtract out the 300 a month for the uh, student loans, also the $500 a month for the truck loan. And since there is no other debt that we count against your income, that means the rest, the $7,325, can actually be spent towards a mortgage payment. So when I'm calculating what someone should or can do according to an underwriter with a conventional conforming loan, I just need to make sure the mortgage payment, which includes tax, insurance, PMI, and HOA, are below that number.
Makes sense.
So what I can do now is I can kind of let's look at a potential buying scenario to see kind of where are the limits of that purchasing power.
Okay.
Okay. All right. So if we look here, I think I have one worked up already, but let me just go ahead and open this up here. All right, so what this is a Borrow Smart analysis software that allows me to come up with different purchasing scenarios, and I can figure out what the monthly payment looks like.
Okay.
So this one already is kind of getting close to where our limit is. We said the limit was 73.25. Right now we have a scenario with a $900,000 purchase price with 10% down. You had mentioned earlier that in this hypothetical situation, we're looking for a single family home, right? So in this scenario, I have a $450 HOA. So let's go ahead and remove that because that would not likely be the case for a single family home. Also for homeowners insurance, because single family homes are a little bit more expensive than condos when it comes to homeowners insurance, let's go ahead and increase this to about $225 per month.
Got it.
And then let's kind of adjust the down payment. So what you mentioned earlier was that you had like $40,000 saved, and you have about $100,000 in combined 401ks.
Yes, that's correct.
So let's try to minimize the down payment then in this scenario. So let's bring this down to say 5%. So we're going to take the loan to value ratio to 95%. That takes our down payment to 45,000. So even in this scenario, $45,000, you're going to need to borrow a bit from your 401k. And so just very quickly with a 401k, you can borrow half of your 401k's value without paying a penalty or taxes. So that's generally what I suggest people do. So you'd be covered in this case. But you can see here, we're not even hitting the limit yet, right? And by the way, for interest rate, I have a 6.19% here only because today is January 23rd, 2026. And as of today, according to Mortgage News Daily, the average 30-year fix is about 6.19%. All right.
Yeah, makes sense. And also, too, I want to just mention that the Trump administration is trying to change that 50% cap. Hopefully, that allows people to use more of their money if they wanted to out of their 401k with no penalty as well. So we'll keep an eye on that. We'll actually put a link to that in the description notes.
Yeah, I think that's a really good thing to keep an eye on. I think that will help plenty of people to purchase a home. But in this case, I don't think we even need to go that far into the 401k to make this work. But so far, we have a payment of $6,433 per month. Since we're putting less down, I'm going to go ahead and increase the PMI premium to, let's say, 0.34%, so about $242 a month, and see if that changes. Because the smaller down payment, the higher the PMI premium. Okay, so we kind of have a base standard at 900,000 with 5% down. The payment's about 6,490. So we have some room to increase this if we wanted to, right? So if we took it to $1 million, now you're looking at a payment of about $7,186, which is still less than that maximum that we could hit, which was 7,325. All right. So technically speaking, I could take this to, let's say, maybe $1,050,000.
Okay.
And now that gets us to just over where we need to be, right? So we're looking at about $1,025,000 is going to be around where we're going to land on this. Do I suggest someone with this type of income get to exactly that limit? No, I don't, because some of this stuff I'm just estimating for now, like taxes. I'm estimating at I would say the Southern California average for property taxes. insurance as well. Some insurance is going to be more expensive in certain places if there's higher risk of fire. So we never really want to go out shopping for a home right at the limit of our budget, right?
Yep.
So I'd say for this person, they want to probably be shopping for 1 million and below.
So let me ask you this
But
question, Byron. Um, we're supposed to get a raise here in the next 6 months or so. So should we wait to purchase before we get the raise? Should we just plan on, getting that raise within our budget now, or what would be your recommendation on how to structure that?
yeah, so is the raise going to be substantial? Like, is it a new career, new job that comes with a huge raise, or is it more of an incremental raise?
Just a promotion within the department.
Got it. So it sounds like it's probably, it's a significant raise, but not something that's going to, I think, change the where your budget is, because, what I don't recommend to people is that they spend half of their gross income on debt, right? So what this represents is spending their half of your income on debt.
Yeah,
So I think that raise, what it does, it actually makes this feel more affordable. Does that make sense?
makes sense.
Yeah. So that's the way I would look at that. One thing to note is that, I think something that people don't realize is that there is also some major tax benefits that come with homeownership. There's also going to be, appreciation with homeownership. So all this payment seems rather high. There are some things that we can reduce out of there to make that payment more affordable. And that's definitely something I go through with people when I'm meeting with them on a screen share and reviewing their options.
Got it. Yeah, that breaks it down.
Yeah. So now, as far as this is all what you can do, right? So this is how an underwriter is going to look at your approvability, and when we submit a pre-approval letter or send you a pre-approval letter, this is what we're basing everything on, right? But about what you should do, that's sort of a different calculation. So, Darren, how do you like to talk to people about what they should do when compared to what they can do?
Yeah, it's a really good question. I really try to also project out in the future, right? It's how stable is their income? Are they planning on growing their family? And reason why that's important is because maybe the husband and or the wife or the partner might stop working, or they might want to take time off and not want to go right back into the office. So really trying to help them project out in the future. And then for me, it's really giving people options, right? So I'll never tell you what you should do. I'm just going to give you options of what it's going to cost you to go plan A, plan B, or plan C, right? And so, meaning that could be all the way down to a location, right? Where it's like, hey guys, you can get that dream home, but it's going to cost you, maybe not going out to restaurants, not traveling like you like to travel, maybe not buying clothes or the car you want, but you'll be this close to the beach, or hey, this close to your job, or this close to, whatever that looks like. And or we can pull a little bit further back from those areas of desire, and it doesn't really change your lifestyle, right? So I really like to really paint a picture for them to see what's really important to them and how important that home is for them. And you do have some people where they'll move to, a coastal city because they love to be by the beach and it's a lifestyle purchase for them. And they're willing to lose 2 bedrooms and downsize their square footage because it's a lifestyle purchase for them. However, for me, that's a win because they understand that they had another option, but they chose to go this direction because that's what's important to them and their family. So, to really unpack that, I just like to really pull everything apart and really paint a picture for the client to project out what do their life currently looks like, what do they think it will look like, and if they did decide to get that perfect home, what that actually means to them from a overall picture. We'll connect it in with someone like you, Byron, so they can really pull apart the financial aspect of it, and just letting them know how much flexibility they'll have if they do that or they don't do that. And that's where different locations are really playing a big part, where we're really seeing a surge of buyers and sellers relocating to places like Marietta, Temecula, Chino Hills, Corona, East Bell, because those areas have, great schools. And a lot of people do work from home and they don't want to really sacrifice their lifestyle as much to stay where they're at. So they're willing to maybe, commute into work a couple days a week because it doesn't change their lifestyle. Right. And so some people are willing to do that and some aren't. So again, for me, it's just painting the picture for them.
Yeah, I think that makes a lot of sense. So for today, I think we've gone over, calculating how an underwriter takes a look at what someone can do, and we've talked about, above and beyond that, like what you should do compared to what the lender says you can do.
Yep.
So I think that is a really good explanation on that. I think we had this was a really good conversation. I look forward to the next one.
Yeah, this is awesome, guys. Go ahead and comment below if you have any questions. We love to hear your feedback. If you have things you want us to really dig into and you have a specific question, hey, we might take that question and put it on our next episode. So thanks for listening. Thanks for watching, and we'll see you soon.
Episode 2. Let's run the math through. What can you afford? Byron Watson, Darren Shepherd.